It's going to sound very straightforward, but you want to really buy stock in companies where you think the product that company makes will be better in the future. The stock market it's a very strange thing. It's kind of like having someone stand at the edge of your property or your house and yell prices to buy or sell your house every day. So sometimes the person yelling out the price of your house is having a good day, and sometimes having a bad day. But it's still the same house.
Elon Musk just issued a bombshell warning that Wall Street doesn't want you to hear. In his most alarming interview yet, the tech visionary said several high-flying tech stocks are on the brink of collapse. These aren't minor corrections, they're potential portfolio killers. While the financial media pushes a buy everything narrative, Musk sees a tech bubble ready to burst. After spending time analyzing tech cycles, I can tell you for free, this warning is different. The data backs it. The timeline is shrinking. Protect what you've built. Don't get caught holding the wrong stocks. Before we proceed, are you new here? Hit that like and subscribe button right now so you don't miss any of our market-moving insights. Let's start by examining what Musk actually said. During a recent tech conference, he stated that certain segments of the tech market are experiencing valuation levels reminiscent of the dot-com bubble. He specifically mentioned companies that are trading at 50 times revenue with no clear path to profitability. This isn't the first time Musk has sounded the alarm. Back in 2021, he called tech valuations crazy, just months before a significant market correction began. What makes Musk's warnings particularly noteworthy is his unique position in the industry. As the founder of multiple tech companies and with connections throughout Silicon Valley, he has insights most analysts don't. When someone who's built several billion-dollar tech companies suggests certain valuations don't make sense, prudent investors should at least consider the warning. However, it's also worth noting that Musk has his own interests and biases. His companies compete with many of the firms that might be overvalued, and he's known for provocative statements. That's why we need to look beyond his comments to the actual data and determine which specific companies might be in his crosshairs. Based on Musk's criteria of 50 times revenue with no clear path to profitability, several tech sectors stand out as particularly vulnerable. First, let's look at the artificial intelligence sector. While AI undoubtedly represents the future, many publicly traded AI companies are trading at astronomical valuations despite minimal revenue. Companies like BigBear.ai and C3.ai have seen their stock prices surge based primarily on potential rather than financial performance. When you see price-to-sales ratios above 30 or 40, you should approach with extreme caution. Second, we have certain cybersecurity companies. With high-profile attacks making headlines, investors have piled into cybersecurity stocks. While the sector itself has strong fundamentals, individual companies like SentinelOne and CrowdStrike have reached valuations that may be difficult to justify based on current financial metrics. Third, some cloud computing infrastructure companies that aren't market leaders are particularly vulnerable. While AWS, Azure, and Google Cloud dominate the market, smaller players are struggling to achieve profitability while burning through cash reserves. Finally, certain electric vehicle companies beyond Tesla are showing classic bubble behavior. Many have market caps in the billions despite producing few or no vehicles and facing increasingly fierce competition. Now let's analyze specific stocks that match Musk's warning criteria. Remember, I'm not recommending you blindly sell these. Rather, these are companies where caution is warranted based on current fundamentals and valuations. First, let's examine some AI software companies with concerning metrics. Companies like Palantir have seen their stock appreciate substantially despite struggles to achieve consistent profitability. While they have impressive technology, their price-to-sales ratio remains elevated compared to more established tech firms. In the EV space beyond Tesla, companies like Lucid and Rivian deserve scrutiny. Despite impressive technology, both face manufacturing challenges, cash burn concerns, and increasingly competitive markets. Their valuations assume flawless execution in an industry where that's rarely achieved. Some cloud infrastructure companies outside the top tier also raise red flags. Companies burning cash while trying to compete with AWS, Azure, and Google Cloud face increasingly difficult economics as interest rates remain elevated. Finally, certain metaverse and Web3 companies are trading on pure speculation. While the technology may eventually transform sectors, many publicly traded companies in this space have little revenue to justify their valuations. It's important to note that I'm not predicting these companies will fail. Many have promising technology. The issue is whether their current stock prices reflect realistic expectations or irrational exuberance. Instead of panic selling, let's develop a systematic approach to evaluate these potentially overvalued tech stocks. Here are 5 key metrics to examine. First, price-to-sales ratio. For growing tech companies, a P/S ratio above 20 deserves extra scrutiny, especially in the current interest rate environment. When you see ratios above 30 or 40, you're paying primarily for hope rather than results. Second, cash runway. How long can the company survive at current burn rates? With interest rates higher than in previous years, companies that need to raise capital face more challenging conditions. Third, competitive moat. Does the company have genuine technological advantages that can't be easily replicated? Or are they competing primarily on marketing? Companies like Apple and Google have proven moats. Many smaller tech firms don't. Fourth, path to profitability. Is there a clear timeline for achieving positive cash flow? Or is the business model still improving? In this market, profitability timelines matter more than they did in the zero interest rate environment. Finally, insider activity. Are company executives and board members buying or selling shares? Significant insider selling can sometimes signal concerns about valuation or future prospects. By systematically applying these criteria, you can make more informed decisions about which stocks in your portfolio might be vulnerable to the correction Musk is warning about. If you've identified potentially overvalued tech stocks in your portfolio, here are strategies to consider. First, position sizing. You don't necessarily need to sell everything. Consider reducing position sizes in the most speculative holdings to limit potential downside. Second, trailing stop losses. Setting stop losses 15 to 20% below current prices can help protect gains while giving stocks room to experience normal volatility. Third, option strategies for more sophisticated investors. Protective puts can provide downside protection, though they come with a cost that eats into returns. Fourth, diversification beyond tech. Ensure your portfolio includes exposure to other sectors like healthcare, consumer staples, energy, and financials that might perform differently during a tech correction. Fifth, consider increasing cash positions. Having dry powder available during a correction provides opportunities to purchase quality companies at better valuations. The key is taking measured action rather than making emotional decisions. Remember that market timing is notoriously difficult. The goal isn't to perfectly predict the top, but to manage risk appropriately. Elon Musk's warning deserves attention, but context matters. History shows that market corrections are normal and healthy, even if they're uncomfortable in the moment. The dot-com crash eliminated many speculative companies, but also created buying opportunities in companies like Amazon and Apple that went on to generate tremendous returns. The goal isn't to avoid technology investments altogether, but to be selective and focus on companies with sustainable business models, reasonable valuations, and genuine competitive advantages. Whether Musk's warning materializes into a broad correction or remains limited to certain overvalued companies, applying rigorous analysis will serve you well. At Oasis of Finance, we believe in long-term investing based on fundamentals rather than hype or fear. If you found this analysis helpful, please hit the like button and subscribe for more clear-headed financial insights. In the comments, let me know which tech stocks you're concerned about. I read every comment and might feature your question in an upcoming video. Thanks for watching, and one last important reminder. This video represents my own research and analysis. Before making any investment decisions, always do your own due diligence and consider consulting with a qualified financial advisor who understands your specific situation. Investment markets involve risk, and past performance is never a guarantee of future results. Stay informed, stay rational, and I'll see you in the next one.